An investing guide, it's all a risk. 3. Chapter 1. Investment one-liners. Investment one-liners. 1. Greed is good. Gordon Gekko, Movie Wall Street. The greatest fear is being the first one in on an investment or the last one. The key to investment success is time, not timing. Before you buy any investment, make sure you know what the fees are. Mutual funds vary widely in fees. A cheaper stock or mutual fund per share is not necessarily better. It's the quality of the investment that matters. Do not buy an investment that you don't understand. If the guy explaining it can't be simple about it, it's a risk. Know exactly what you own in your investment portfolio. Be willing to learn and change the way you do things. Don't be too quick about investing anything until you check it out. If someone truly has good financial information, he or she will keep it for themselves and not blab it around. The people in the money business are out for themselves, not you. While I watched PBS's documentary about the 1929 crash, it was the same story I see in the financial media. They will always tell you the outlook is good even if it's going to hell in a handbasket. For them to tell you otherwise would be to lose their chance to make money, and that's what they're all about, making money. Some financial advisors and brokers feel bad about losing clients' money at the beginning of their careers, but after a year or two, they became callous to it. Their job is to become buddy-buddy with you, get your money, then after that, they don't care. The truth is that nobody knows where the market is going. If they act like they do, then you know they're liars and not to be trusted. In the long run, there are no free rides or investments highly superior over others. If a stock or bond is giving yields way over all the others, chances are it's a scam that's going to bust. Don't trust financial advisors. Don't give them power of attorney over your money. Let them give you advice if they want, but the money stays in your name and you make the transactions yourself. Read the fine print, or the banks and brokerages will take you for hidden fees before you catch on. Don't buy gold unless you take physical possession of it. The common way is to give you a certificate and supposedly hold the gold for you. I remember the old Sonny Block, radio talk show host, gold debacle with his advertising sponsors. Don't fall for it. People with real money are not in the investment newsletter business. If the people selling these investment newsletters are so smart, they would have enough money such that they wouldn't have to write monthly investment newsletters and sell them. If you're serious about playing stocks, you will make a lot of money and lose a lot of money. Good companies get competition, a lawsuit, or miss on a new concept and suddenly they go way down. Even infrastructure companies can go bust when a new concept hits. Computers destroyed typewriters. Cell phones and the internet may eventually destroy the basic home phone. If they get cheap enough, they will replace it. Products fall out of favor on a whim. Something new comes up or the public gets tired of it. There's no crystal ball. I lost big on several supposedly stable stocks. There's nothing stable in technology. The only thing stable in life is the grapes of wrath type products, food and a roof over your head, but these companies all have competition, and if you invest in pineapples like Del Monte or Dole, a bad year could wipe you out. Hardware, like plumbing, is the only thing that everybody needs. People go crazy without plumbing or garbage disposal. I already talked about my approach to find lists of the best performing stocks and go from there. I already said that any so-called expert's guess is as good as yours and that nobody has a crystal ball, hence your educated guess is as good as anybody's. Be wary of financial advisors and stockbrokers who constantly trade your stocks simply to get their cut of the deal with little regard for your money. The so-called experts constantly contradict each other. Everybody has their own theory and nobody's is superior to yours. Although I talk about the best performing stock lists as the lazy investor's way to go, be forewarned that any stocks on that list may already known by the mainstream, hence your opportunity could be gone, although not necessarily so. The true magic in stocks is simply to do your own research to find the obscure gems of companies that almost nobody knows about. Some companies skyrocket up to 3,000%. If you can find that one or two, you have got it made, but there are many false leads and phonies in the bunch. Insider knowledge means knowing something about a company's movements before it's announced publicly because of a tip an insider gave you. It's illegal, but many people in the business do it. You probably don't know anybody who can give you insider knowledge anyway, and if they do, you have to be wary that it's just hype. Your best bet is to stick with good research via the filings and the general media. Don't trust internet chat lines or independently owned websites not affiliated with a major media agency. Making it in stocks is simply all about intelligent, meticulous research to find these gems. The hardest worker does the extra research to find them. Are investment newsletters worthy for the information they give you, some of them costing up to $1,000 for a year's subscription? I refer back to the old adage, nobody knows more than you, plus the fact that some newsletters try to hype up stocks that they have an interest in. Your best bet for research is the old tedious corporate filings and the general media for articles and tidbits about a company's or sector's movements. The things that affect the stock market are supply and demand, emotions of the investors, societal factors, and factors in the company like management. Investing is slow growth. Good stocks, in my opinion, are the best investment. Find good stable companies. I say mix these companies with a few high-tech companies for some aggressive investing which could pay off big, or you could go bust. In my opinion, life is worthless if you don't take risks sometimes. Save as much as you can afford from your paycheck. Diversify and keep some safe emergency money in a very liquid savings or money market account. After you have invested in several good stocks, put them away and don't bother much with the daily business news until you're ready to liquidate or make a move. Evaluate your stock well before you buy it. The company's earnings signifies its profits, so just like at that. If it's constantly rising, it's a good sign. As far as mutual funds go, the consensus seems to be to buy index funds which closely parallel some of the indexes out there like the Dow Jones Industrials, the S&P, Nasdaq, etc. Hot tips generally end up to be duds, with you kicking yourself saying, "What was I thinking?" Whenever there's a correction, don't panic and bail. They usually correct after 9 months. If the market is good for 30+ months, expect a downturn because that's the way the sheeple investors are. You might want to get out for a few months to avoid those wild downturns on your statement. Sector investing could be a wise thing to watch. For example, when an upstart company in a relatively new industry is doing well, rest assured that other companies in this sector will do well until they become saturated. Just look at the computer industry back in the early 80s. If a company in a sector starts to go bust, watch it, it could be a trend in the making. Another thing if you're into risky investing is the undervalued company, a company that has had good times, is currently having bad times and could get better because it's a fighter. Look for stocks out of fashion or season. If a company is having a bad quarter but is a good company, consider it. Basically, just watch TV for when the experts give their picks, go to the computer, and if the graph has been going up for the past 2 years, buy. Keep it simple. Don't read complicated verbal diarrhea books. Let the experts find the winners and research their picks. Just go to the free websites and the one set up by your account company and look around at the different stocks. There's so much advice out there that I have to minimize it. It's always all about tech stocks if you want to make money. Every book is outdated in 6 months, so don't waste money on stock books. In order to really win at stocks, you got to study them just like the pros do. You're going to lose money. Play it cool. Your big stocks will compensate for your weak ones. If you can't handle risk, stick with the industry leaders. Try to make friends with people who play stocks to exchange info with each other. Don't trust internet chat rooms. Don't own too many stocks. Keep your good ones and put more money into them. Don't gamble. There are plenty out there to buy just good businesses. Have an exit strategy just in case it goes too low. Don't overlearn. It will just blow your mind. Play it cool, balance your life with other interests. I already said keep it simple and diversify somewhat to minimize risk, although if there's a winning sector or trend, stick with it for a while. Don't just buy stocks and forget about them forever. Check on them periodically and decide whether to sell or stay. Continue to learn. You can never learn enough. Keep it simple though. Stick with 10 stocks over 100 which drive you to stress because you're always worried. If a risky stock keeps you worried, sell it for peace of mind's sake. It's too hard on the brain. Remember, it's all about emotions. Don't stick with a bad stock and don't sell a good stock too soon. If it's a great stock and you know it, bet a gold mine on it. Keep close tabs if there's something going on and dump or stay based on logic alone. If you screwed up, dump it and minimize losses. It's always about your tolerance for risk. The greatest gains come from the greatest risks, but so do the losses, so that's the game right there, a big game of gambling. If you're tough, you will be able to hold strong during the storms and stay for long run. It's all about company growth. Go for the long term. Be patient. Look for stable, well-established companies with a long-term track record. It's not about the market. It's about your particular stocks. If you have got savvy, use it in all markets. When the market is bullish, look for the winner that's peaking, then sell right when it's on the crest. When it's bearish, look for the undervalued deals. What goes up usually comes down. Unless you're a true prize like Microsoft, most quick gainers will come down. Either avoid all quick gainers or buy then when the value goes up by 20%, sell. The greater fool theory is that there's always a fool greater than you who will buy useless investments until the fools run out. This is the way many investment professionals think when they have useless stocks: dump them on fools. Be wary of them. One guy says that if you have got equity in your house, sell it, buy a cheaper one or rent and invest the money in something that will give you interest. In the long run, a true test of a company is its growth. If it continues to grow, then it must be doing something right. Don't always look for glamorous high-tech stocks. Some dull stocks in basic, high-need products are winners. If a good company has a stock split, it's a good sign it's doing something right. Try to be a rational investor rather than an emotional one. Educate yourself. Don't be too timid nor too aggressive. You're not special. You can't beat the market on a whim. Only good knowledge will beat it. The best strategy is to pick a few good stocks, then don't waste time on the stock market. Sit on them. The market will always be volatile and risky. Live with your decisions. Some people say tech stocks are great, some successful investors think they're too risky. Investment one-liners 2. Peter Lynch said that you shouldn't invest in anything that you can't describe with a crayon. Keep it simple. Don't invest in complex concepts. Once your stock goes up, monitor it to see when performance dips, then sell. Beware of investment advice. I trust only the graph which tells me where the company has been. You get wealthy by studying one sector of investments you're interested in, becoming an expert and taking risks on your knowledge. Stocks are simple. Keep it simple. There's no shame in losing money. Everybody does one way or another. Just don't lose the same way twice. If you can't handle the risk, don't invest in stocks. Take a stand, take responsibility, take risks. Nothing has guarantees. Be thankful for what you got right now. Invest in the leaders of their industries. A number of small gains are just as good as the big gains. Winning investments usually keep winning. Beware of one-product companies. Good companies always expand. Buy stocks in the depths of the bear. Get out after a bull market of 18 months. It will crash at some point or at least correct. Your best bet is to avoid short-term market fluctuations and focus on picking a good stocks impervious to ups and downs. Don't overanalyze the market too much. It just wastes time. The market as a whole in the short run is human emotions, which is useless. Don't be afraid to buy foreign stocks. Taxes will always take a cut of capital gains. In some cases, a stable savings bond or GIC at 5% is better than the uncertainty of stocks and funds. Mix up the risk level of your investments. Keep a few stocks, then some money tucked away in a completely risk-free investment. Find good companies with a track record and a good size, worth over $100 million. When Sam Walton, creator of Walmart, once the richest guy in America, lost $1.5 billion in one day in the crash of 1987, he said it's all paper money anyway, which is a good attitude. To know his worth on paper didn't relate much to his worth in real life. Don't go out of your realm of competence. Stick to investing in what you know, both investment instrument-wise and in the type of stocks you buy. Don't follow the herd. Follow your own game. In investing, action without thought is the kiss of death. Keep your investing life simple. There's no much info out there. Focus only on your little part of it. Don't invest money you can't afford to lose. If you make a good return on an investment, respect your profit, take it and move on. Any company that grows too fast but doesn't have an explosive product line, is one to be wary of. Growth at any cost will usually lead to a crash. When you make an investment that tanks, study it, learn from it, and don't repeat that mistake. Educate yourself about money with a passion. Look at investing as fun. Don't pick the popular stocks because if they're popular, it means the bandwagon has been there and left. Buy a stock as though you were buying a private business. Know the companies you're buying. Invest in dull basic companies. Investing successfully is all about growth. Find companies that are growing faster than the rate of inflation. Accept the ups and downs of the market. Take the long-term view. Don't listen to stock tips without checking them out. If it keeps you up at night, don't invest in it. You'll win some and lose some. Keep fighting for your vision of utopia. No risk, no reward. The larger the risk, the greater the potential for both profit or loss. When the S&P 500 drops by 20%, it's time to buy stocks. The year before a national election and the year of the election are good for stocks. After that, stocks seem to decline. November to April are the best half of the year for stocks. Whatever happens to stocks in January usually stays constant throughout the year. If there are 2 years of double-digit increases in stocks, get out. It's ready for a bear. The first 4 days of a new month and the last day of the month are the best to buy stocks. If you don't understand it, don't buy. Disregard all hype. If in doubt, invest in real estate. Prepay your mortgage off quickly, then buy a rental property. There are no get-rich schemes. A few people always luck out, but most work hard for the money. Don't buy stocks out of greed. Buy them out of a sense of long-term equity. Avoid trendy stocks. Don't follow the crowd. Go opposite to what they're doing. Keep it simple. Don't invest in tech companies with complicated products. Don't bet on a comeback until you see it happening. Life is not fair. Sometimes, everybody gets lucky. Spend less than you earn and invest what's left. Don't curse what you don't have. Appreciate what you do have. Real estate stocks are generally shaky. Long shots are almost always losers. Don't buy new stocks until they're making it beyond the hype. Be contrarian, look for undervalued stocks in underglamorized sectors. If the company's rate of growth increases then falls, sell. You might think you should buy companies in a growing sector, but cell phones and the internet had a glut of companies when they all crashed. Everybody wants to get on the latest craze, then there's an oversupply. Buy quality companies at least 15 years old over the flash in panners. Stay away from sectors you don't understand, like the wild swings of energy stocks due to some seemingly unrelated world events. If the company decreases its dividend or eliminates it, sell. If you make a 25 to 50% gain, that's respectable. Unless the company is really hot, it's already peaked, so sell. When interest rates are high, people buy less stocks so their value goes down. Don't ignore little things like fees and taxes. Using a stop-loss order can protect gains or limit losses. Tell the company at what value to sell. Don't sell at the first blush of bad news. There's no get-rich-quick scheme. Nobody can time the market. The economy doesn't matter. The individual stock does. Buy blue-chip stocks. Don't beat yourself up over missed opportunities. Invest in companies in growth fields. Don't react immediately to any business headline or breaking news on the stock channel. In general, big companies remain stable in bears while small companies grow faster in bull markets. Fannie Mae and Freddie Mac are government-sponsored, therefore insured, so they're generally good bets. Simply follow the media. When they report a company with better than expected earnings, it's a good stock. If there are employee layoffs and plant closings, sell. Who is behind the venture? Is it an investment or a gamble? Can you sell it quickly if need be? No hassles involved? Investment one-liners 3. Value investing is to look at the intrinsic value of the company, not just the numbers. What does it produce? Is it useful? Do they do it efficiently? Choose the value of a company over its current popularity. Buy a stock as if you were buying the company as a private venture. Buy into a sector you know about and/or use those products. The Templeton philosophy is to buy good company stocks that nobody else wants, those at the point of maximum pessimism. Look for growing companies. Balance a traditional, value company with a growing one to find companies that have a mix of both in them. When stock popularity and hype reaches a point that defies good sense, get out of the market. Nothing is certain. You have to take care of yourself. Nobody else will do it for you. Buy when everyone else is selling and hold until everyone else is buying. John Paul Getty. The biggest fool is the one who knowingly pays too much for a stock in the hopes that even bigger fools will buy it. As long as we have these fools, the market will always be a roller coaster ride. Emotional thinking without the facts will get you in trouble in the investment world. Intuition doesn't work unless you've got some knowledge backing it up. You can't control what a stock or fund will do, but you can control the risk by analyzing what's out there, then investing in low-risk investments. If you invest in emerging tech stocks, who else can you blame when they go bust? Slow and steady is better than a brief rocket shot before the crash. Don't put all your eggs in one basket. Diversify no matter how good it sounds. Don't buy a stock unless you plan to keep it for 5 years. In other words, pick companies that you think are going to be there growing. Technology is always where the big winners are, but along with them are a lot of turkeys. Don't invest based on hype. Invest if the company has actually made some money. Real estate is usually a good investment. Get my real estate book. Put money away in tax-deferred retirement savings plans. Nobody knows the future. Anything can happen. Don't listen to the talking heads on TV too much. If you can't handle the risk of possible loss, don't invest in the stock market. The stress and pain will not be worth any possible gains you might experience. In order to avoid the need to time the market, simply buy good, conservative stocks and hold them for multi-years. It's easier to make money in a bad market than a good one because the downside risks are lower. Avoid the fad stocks. Avoid inside information, but check out stocks that have some negative spin to them because some of these bounce back big. Instead of going for a bunch of good investments, look for the few great ones and stick with them. Don't overestimate the wisdom of the talking heads on TV. Don't give in to fear. Listen to yourself. Do some research and go from there. Don't just stick with American stocks. There are good foreign stocks too, some on American stock exchanges. Cash flow is the bottom line of any business. You can easily see how much they owe, how much they're generating and what they're paying themselves. So if a company is getting the bulk of its money from stocks and not through selling product, don't buy it. The major categories are as follows. There are good stocks in every bunch. Consumer products, energy, entertainment/media, financial services, healthcare, news/information, retail, telecommunications. If earnings per share go up consistently every quarter, buy the stock. Buy companies you use in everyday life. Someone said low-priced stocks under $10 are those usually on the way down and 70% will be bankrupt in 2 years. Good companies generally get better. Even if the stock rose dramatically over the past year, it may still keep going. And don't necessarily sell a good stock just because you made some money. If you hold, it could make you rich. A very important factor to consider when looking at a stock is how much debt does it have. If it owes nothing and is making a profit, buy it. To find in-depth inside information about a company's movements, you have to pay attention to the media, particularly the articles in the Wall Street Journal. Anyone that says they have a formula for success is a liar, 'cause there don't none. Don't buy any investments advertised over the radio or from a cold telemarketing call. Stockbrokers sell you the stocks used by their brokerage houses, meaning they favor their own stocks which they have an interest in, and that means possibly screwing you. They also have friends from the corporations who give them kickbacks for pushing their stocks. They also get commissions for selling, so they will try to get you to buy as much as possible. Do your own homework. Don't listen to any hype and don't buy anything quickly. Never follow the crowd or the hype blindly. Don't listen too much to market gurus. Don't buy on tips or rumor. One guy on the radio said every tip he ever got turned out to be a dud, so there you go. The truth is that if there's a real hot tip, the brokers and the insiders at the office will get in on it and pass nothing on to the individual investor but sucker bets. Call up some of the full brokerage houses and act like a naive investor to see what they will send you. Some discount brokerages might send you some basic information, but that's about it. Stockbrokers and brokerage houses work on commissions, so they want your money, end of story. Check with either the National Association of Securities Dealers, Inc., or your state securities administration office to check them out. Securities brokerage firms come in all shapes and sizes. Some are large and offer securities from all sectors of the market, while some are smaller, choosing to focus on securities from one region or in one particular area of investment. You have to shop around the brokerage firms to find what's best for you. The demographic emerging as the one with the money and the biggest population is aging baby boomers who are starting to move on to retirement age. Presumably, the things they spend their money on should be good stocks like healthcare, pharmaceutical companies, drug stores, RVs, retirement communities, gardening, cruise ships, golf courses. They're also nostalgic for the 50s and 60s and support pop stars and movies from that era, which Disney owns a lot of. They're not frivolous, they don't buy trendy things and generally stick with the proven basics. They're conservative savers because they're facing retirement soon and have to watch their money till death do them part. As the world population increases, so do markets increase. The stable companies in the United States like Coca-Cola, Walmart, and IBM are expanding all over the world, therefore they're good investments. Ask a successful mutual fund for a copy of its semi-annual report which lists the stocks in its portfolio. Copy what these fund managers are doing. Sometimes companies making changes make rights offerings to their investors to buy certain stocks at discount prices. If that ever happens to you, it will be wise to consider it. You either buy the stock, sell your rights, or let them expire. During a bear market, if a good company drops a lot, that's the stock to buy when the recovery comes. Go for a few winners rather than a bunch of half-baked stocks. Don't waste money on tapes, seminars, books, etc. promising incredible returns. The only one making money is the guy selling the stuff. Buying the right stock is the real issue, not the time period you should keep it. Good information is everything. Don't trust company CEOs, mainstream media analysts, or internet hot tips. See for yourself if the company is turning a profit or is it just hype. Look at their earnings, money taken in. Buy for the long term. Buy when others are selling, in a bear market. Avoid anything too good to be true. The best investors are those who focus on only a few sectors, know these fields, study the companies and pick the best. Avoid emerging markets. The next best thing ploy is tempting, but many go bust rather than become a Microsoft. Several conservative investors say don't watch stock market TV. Learn whatever field you work in and where your personal interests are and invest in those companies. One guy goes to restaurants and invest where he gets good service. If your kids like a certain product, check it out. If it's a product you need, check it out. If sick and/or old people need it, check it. If teenagers like it, check it out. Get rid of poorly performing stocks. All stock analysts are bullish because that's their business. Would you badmouth your bread and butter even if you knew it was dying? If an analyst is in the least bit not bullish on any stock, beware of that stock. Somebody said an analyst has never met a stock he doesn't like, which sums it all up. If a company needs an extension for a quarterly or annual rate or changes accountants/auditors, sell now. Sometimes a company wants a stock price to go low so they can buy back shares. If company management unloads a lot of its own stocks, watch out. Don't buy what stockbrokers sell, buy what they buy. Learn to read between the lines. Analyze news stories for their impact on specific industries. Don't invest using a rear-view mirror. Last year's winners may not repeat the cycle. If it's too hot a deal on an unknown company, don't buy. Stick with proven companies. Don't overload yourself with info. Instead of buying 1,000 shares of a company in a sector you like, buy 1,000 shares in 2 or 3 different companies in that sector. Dump all stocks that are everybody's darling. It's much too popular to stay up. If you want to make money, sell while the market is still up. Don't wait until it drops. Don't hold on to losers in the hope that they will turn around. Get rid of them. Don't make investing decisions based on your income tax. Make decisions based on the market. You will make mistakes, so make it a point to lose the least amount. If the stock drops by 7% of what you bought it for, sell it without any extra thought. It's easier for peace of mind. Don't buy on the way down. Play defense. Always protect your account against severe losses. Learn what really makes the economy run. Limit shocks by not taking risks. The reward isn't worth the risk if it causes you stress. Save and invest rather than spend foolishly. Sell half of your stocks that go up 20%. You can look for other winners elsewhere. Get out when the going's good. If a stock has a rapid rise over 8 days or so, sell. There is always risk. Don't listen to people you don't know. Don't be too greedy. If you inherit money or otherwise get a big lump sum, invest at least 80% unless you use it to buy a house. Pay off your house as soon as possible. Forget the grand slams and home runs. Focus on moderate gains with safe quality companies. Stay away from what you don't know, like tech companies. Validea.com, they look at what the top financial analysts and investors do, then summarize their findings, what techniques these high rollers use to pick stocks. Investment one-liners 4. Diversify to at least 6 investments, like 3 stocks and 3 mutual funds. Cut losses by putting a sell order/stop loss order on your stock if it goes below a certain value. When you make a decent profit from a stock, sell it, then wait 6 months to see how it's doing. Some stocks constantly cycle, up and down. A profit protection stop is when you put an automatic order in to sell the stock when it goes up to a specific price. Charting is looking at a stock's price on a graph for the past several years, looking for a pattern, then making an educated decision on the future of the stock. Don't buy stocks that seem to be worth more than what the company is really worth. Keep good records/a trading diary, because you can't possibly remember everything about every stock. Whenever you see a CEO being interviewed, know that he's at least 35% cheerleader or hype. CEOs are not allowed to break new news in the media by law. They have to do it by press release. You watch their tone and body language. An exceptionally exuberant CEO is bad news, because good CEOs are calm, methodical people. If it's slick hype, he's hiding something. If he's critical of others, that's a red flag. It shows he's angry at something. In a down market, even good stocks go down. Understand the different sectors, then pick a sector on the way up. If there's a rally, cash out after 5 days of straight gains. A heavily hyped stock will crash in a week or two. Go to actionalertsplus.com. These are the stocks Kramer picks. He's a money junkie. He is usually right. Find the biggest gainers of the day, watch them for 3 days. If you decide to buy them, keep them for a week, then decide to sell them or keep them. In a political year, if it looks like the Democrats will get in, buy social service type stocks. If it looks like Republicans, buy defense and oil stocks. If you don't really like the game or hobby of investing, don't do it. Put your money in a government savings bond or buy a property that you use for rental income instead. If you own a stock that just had a good run, sell now because most usually go down after a good run. During a bear market, there are very few sustained gains but lots of false starts. Even if you see a stock starting to go up on the graph, be very careful before you buy it. Buy stocks on the way up, not on the way down just because you think they're bargains. Save and invest. I don't bother with insurance much, but a lot of people buy a lot of insurance. A liquid investment is one that you can turn into cash quickly, such as savings accounts, stocks, or mutual funds. In your 20s and 30s, the best value in life insurance is term insurance issued on an annual basis with no cash build-up value. As you age, permanent insurance is more expensive, but it has a cash value that builds up and the policy can never be cancelled once issued as long as you keep up with the payments. Your inheritors get money if you die. Rather than buying stocks or mutual funds, consider starting a side business or buying a house to rent out. Certificates of deposit go from 30 days up to 10 years. They're safe. The interest rates aren't bad. If you need your money back before the date of maturity, there are penalties. Government savings bonds are safe and they pay reasonable rates of interest. Most investment advisors know very little about what they are selling and they have not bought any of it themselves. They are ordered by their boss to sell the stocks that their financial firm has underwritten, made it into a public offering stock. If a financial advisor was really smart and making money, he would be day trading on his own, not bothering collecting commissions with average investors. When the stock market turns down, the financial advisor loses nothing. You lose everything. Examine the real assets of the company, the cash in excess of its indebtedness and the value of its physical properties. Does this stock/company or perform a service that people want or must have? Don't day trade unless you make it a full-time job. You're competing with people who spend 50 hours a week on this stuff and have allies that give them insider tips. Beware of anyone offering inside information. It's illegal and they're making money by upping the price of the stock. With computer trading today, don't be greedy. Set a sale price on a stock which will make you a profit, then when that's reached, your account will sell it automatically. If you see that the stock is going down, cut your losses as quickly as possible. Use the stop loss technique. Put in an order to sell your stock at 8% 10% below the highest price at which you have owned that stock. Be aware of the capital gains taxes that are applicable to your transactions. Don't invest all over the place. Stick to one medium like stocks and focus on one or two sectors. Take your profit too soon rather than too late. Every investment is a gamble. Minimize your losses on the downside. Sell at a loss. Optimism doesn't matter. Knowledge does. Think through every decision for yourself. Don't blindly follow media articles. Investment opportunities come all the time. Don't worry about missing a good deal. Most mutual funds charge a commission. The ones that don't are called no-load mutual funds. There is very little difference in investment return between the load and the no-load funds. The biggest winners bet seldom, but when they do, they bet big. If you can't handle the risk, don't play. It's all about risk. Never forget that investing in stocks is gambling, albeit with intelligence, but gambling nonetheless. Never underestimate crowd or mob psychology. This causes more crashes and bears than anything else out there. The stock market comes down to the investor's beliefs. When you're diversifying, don't diversify by keeping all your assets in the same category of investments like all growth stocks. Diversify in different sectors. This means that within stocks, invest in different sectors. Consider investing in some foreign stocks and invest in other things besides stocks like bonds, mutual funds, real estate, treasury bills, gold, etc. Smaller stocks but not penny stocks generally have better returns than big stocks, but they're also more volatile. Don't invest more than 10% of your worth in any one stock. Don't believe the hype of new stocks. Wait a while. Deal with stocks that have been around for at least 5 years. If you want to invest in bonds, try bond mutual funds. Be aware of the tax implications of investing. Control your emotions when you are winning and losing. Don't get hooked on greed. Be proactive with good education rather than reactive when the market dips. The only constant is constant change. Protect your principal, don't take unnecessary risks. If you have a reasonable gain, take it. Sell. Buy as if you are never going to sell. The graph only matters if it's been going up for at least 5 years. Buy stocks of products you understand and use. Be wary of one product companies, especially in the tech field. Take your time. Don't jump into investing. Don't invest in the gimmicks like antiques, precious metals, coins, art, stock options, futures trading, short selling, whole life insurance, etc. There is no best time to invest. There are always winner and loser stocks out there. There are gurus everywhere. Be your own guru. It's not the market, it's individual stocks that make money. There will always be good and bad. Don't over-diversify. Don't invest unless you are willing to do some research. Stay basic. Focus on quality stocks who are the leaders of their industries. There's no certainty anywhere. Do your best. Accept your losses. Buy when the market is down. Hold your stocks for years. Buy and hold seems more stable than day trading. Take every tax break there is. The greatest risk doesn't always yield the greatest return. Safe investments in stable companies are pretty good without the risk. Don't act on new information because you want to get on before the herd finds out. If it's good, the stock will be good in a year. Don't be overconfident and hold on to a clunker because you think it will get better because you own it. Don't think get rich quick because it's rare. Don't always be looking at the current winners and switch to them. Don't react to today's headlines on stock market news. Don't buy penny stocks just because they're cheap. Some turnarounds do well. Since technology is all speculative, it always crashes when the market goes down. If it sounds too complicated, don't invest. If your stock rises then appears on the cover of Business Week as a winner, sell. If a stock goes down significantly for 5 days straight, sell. If you buy a stock that rises well then starts dropping, sell. Takeovers, friendly offerings, and hostile bids on a company means that someone's interested and the stock will usually rise. Always watch what the company management is doing. Do they invest in their own company by buying its shares? Don't necessarily buy a stock because the price is going down. The company may be on the way out. Banks are a traditionally safe, strong stock. When the prime rate is below 10%, companies can borrow money at low rates and increase production, therefore it's a good time for stocks. When the prime rate goes above 10%, get out of stocks and invest in money market funds. Everyone says diversify, but realistically, don't buy more stocks than you can realistically watch intimately. Don't spread yourself too thin. 12 stocks in different industries is enough. Look over the weekly loser lists. If it's in a stable industry, consider buying it. Invest in health and natural resources. They never go out of style. Don't cash in small gains. Hold on to them. When the market has bottomed out as indicated by the media writing bad things about it, expect it to swing back shortly and start investing right then at that critical change of momentum time. If the market goes AW on the graph, meaning a dip, rise, dip then rise, it probably means that it will continue to advance. If it's an M, it means that it will continue to decline. If you're really keen, get the Sector 1 3D filings of corporations and watch for any significant changes, then act accordingly. They're required to file within 10 days of any changes that will affect the company's value by more than 5%. Smaller firms worth between 20 to 100 million with room to grow may be a better investment than the big companies that basically just stay in one place. The days before long weekends are generally bullish. Stocks reach their lowest points at around 10:45 am, 1:30 pm, and 2:50, so buy during those times. Mondays are weekdays for the market and Fridays are the best days. You don't make money buying after everyone else has bought. Some of the best deals happen when there's a bad turn, everybody sells, then you go in and buy. After the market bottoms out, wait until it shows gains for 3 to 4 days straight, then start buying again. Some of the best stocks are bankrupt companies. Be patient, buy when it has bottomed out real low and watch for any signs of recovery. If a company has been in Chapter 11 for a while, it means that it's trying to recover. Toys R Us was a bankrupt company. Also be on the lookout for down and out companies going through a period of restructuring. Recapitalizations, a company repurchasing its own stock with cash, bonds, or preferred stock, could signal an increasing valued stock. One way to spot a good investment is if the company has a cash reserve greater than 15% of its value. Don't trade often and pay those commissions. A good stock will be stable over time. Rich folk keep stocks over generations. The relationship between interest rates and stock prices is inverse for a number of convoluted reasons, meaning when interest rates go up, stock prices go down and vice versa. Gold mines can be big phony investments just like spec oil companies. Investment one-liners 5. Most penny stocks never recover to the price at which they are initially sold. Stay away from commodities unless you are willing to study it full-time and lose lots of money. Start saving young and invest for the long term. Participate in the company retirement plan. Every wealthy person started saving in small amounts. If you start saving $40 a month at the age of 25, it will compound in interest and add up. Once you start buying stocks, don't buy and sell too much. Don't spend much time thinking about the stock market unless it's a personal hobby you really like. Personally, I can think of more interesting things to do. Don't watch money TV too much. I'd rather watch the Love Network. Get my drift, just buy and hold. Don't be too greedy. Go for steady gains with stable stocks. Don't pay attention to the daily fluctuations of the stock market. You're in for the long haul. Investors Business Daily has categorized the stock market into 197 categories like computers, semiconductors, cable TV, etc., and ranks them on a weekly basis based on performance. Investors.com. The Economics section of the World Almanac, number 317 at the library, neatly summarizes all the winning corporations for the current year. The market will probably fall when NYSE members start short selling. The number of stocks reaching new highs starts declining. The Federal Reserve System increases its interest rates, meaning people will borrow less money. The number of companies reaching new lows starts increasing. Prior to a presidential election. Overpriced market, meaning that everyone thinks it's going to be bullish forever, and if only one market index like the Dow Jones Industrials increases while the others aren't doing so good. A stock is worth what someone will pay for it. It's a two-way street. Oftentimes, the true value of a stock doesn't matter. What matters is the investing public's perception of that stock. Your job is to outthink them, anticipate when they will think a stock is great or bad and act accordingly. The investing crowd is fickle and irrational. Don't question it. Just try to beat them by predicting what they will do and do it before they do. There are many bubbles in the stock market based on pseudo-dishonest hype. Your job is to look for companies with a firm foundation as opposed to hype by insiders. You're looking for the true worth as to worth based on hype, hopes and dreams. Ask the following questions. Does the company bring in money? Does it make a profit? Does the share price go up? Does it grow/expand? Is it a stable company in a stable industry? What is your best analysis of the future of the company based on good research as opposed to hype? If a company seeks out world markets, it's probably a winner. Think independently, don't listen too much to the heads on TV, each with their own agenda to sell the stock they have an interest in. Find the cyclical stocks, the ones people buy when the economy is good like cars, then buy that stock while the economy is good and sell when it goes down. Look for individual companies, the sector they're in, how much sales they're doing. Bargain investments are usually low-quality investments. The usual trend is to buy high when the stock is on the way up and sell higher. Stay away from tech. Stick with more conservative stocks that have a track record. Look at an investment as though you were buying the entire company, not just stocks in it. Find the top few companies in any field. Know the industry. Analyze what you expect it to do in the future. If you see a stock you like but you think it's priced too high, wait a while to see if the price goes down. After you buy, forget it for a year. Look for companies making a consistent profit without much debt. Look at the overall economy and get a feel for it. What is your opinion of the industry? Is it one that could go belly up if new technology replaces it? A good investor looks for a company in between a good foundation and some hype. The hype will keep the price artificially high for a while where you can make money from its price gains, but when the hype goes, get out, wait until the price goes down, then buy it back. Trade as little as possible. Buy a few, well-researched stocks and sit on them. Never forget that despite all the analysis, there is still a large random element in the stock market. Nobody knows anything for sure, not even the so-called experts. Many are incompetent and liars for their own self-interest, i.e., hyping up stocks for their own gain. There will always be risk in stocks. You reduce risk by diversifying the sectors you buy stocks from. If all your stocks in technology, you're screwed if the entire field crashes. Have patience. Don't try to get rich quick because it rarely happens. Try for safe, modest gains. In any city with good industries, real estate is always a solid investment. Smaller companies are generally more profitable than big companies. Try to find one or two friends who also invest and talk to them every once a while to get their tips without the media hype in the way. Don't buy a timeshare. Continue to learn about anything that will better your life. Don't buy a new car or too big a house. Live below your means. If you can't afford it, don't buy it. Save, save, save your money and invest it. Investment one-liners 6. Higher priced stocks are the ones getting better, not the low priced, cheaper ones. For peace of mind, sell a stock quickly after a small loss rather than wait and hope it goes up. Focus on where the company stands in its field, its profit growth and volume of shares traded. Listening to too many analysts just messes you up. It's all about the graph. Is it going up consistently or not, and is the volume of trades on it going up? Both together signify some kind of buzz. How are earnings this quarter and this year? Is the stock a leader in its field? Is the field one of the better ones? Do you understand the history of the company? What is the company doing? Do they have new products? Are they doing something good to great? In order to play it safe, always keep a limit order. If the stock drops about 10%, sell. The truth about most market leaders in emerging fields is that they reach a peak then drop by a lot. If you own stock in a tech field, watch the stock rise, then when you sense it's high in the heady, abnormal sense, sell. It doesn't matter if you sell it on the way up. Take the money and run. Most great companies go way up then go down. When a stock goes up a lot, the mutual fund investors and professional pools sell. That's the time to get out. Companies where top management owns a lot of its own stocks and buy back their stock are good prospects. Stocks owned by mutual funds, pension plans, etc. are good to a certain point, but when it gets excessive, get out because they will blow at a moment's notice when they sense fear and the stock will plunge deeply then. Watch the market in generally. When you sense panic, it's time to sell. Nothing goes up forever. When you buy a stock and make a good gain, don't tempt fate, sell. A Google or Microsoft comes around once every 10 years, a stock that keeps going up. They're flukes. Information is the hard currency. Find your own people you trust, either the big investment publications who have to be objective, otherwise they will lose credibility, and a few loner, small ones doing in-depth reports. Ignore the message boards on the internet. Find a few money websites you like and use them. Be selective about who you watch on TV. Remember, anybody who works for a brokerage is always trying to sell something. If your time is valuable, don't waste it studying stocks. Pick a few based on your best analysis, then forget about them for a while. Earnings announcements are bad times to buy stocks. Wait for 2 weeks until the hype dies down. If you want to play it safe, buy stocks from the Dow Index. If you're willing to gamble, look at emerging markets and international stocks/ADRs. Invest in companies and sectors you know about. Make a list of consumer products you use and restaurants you eat at. Check out their graphs. Make a list of several things older people use. There are more people getting older in America all the time, and they're the ones with the money. With taxes and trading costs, don't make too many trades. Stocks go up until everybody with money is fully invested, then they drop. When everybody around you is pricing roses and champagne, be ready to pull out and sell your stock. It's always about the company's earnings and cash flow. Watch out for expenses too. When you buy a stock, I presume you buy it on the way up. Watch it until you sense the trend is changing, then sell. If a company asks for and gets an extension in mirroring its quarterly earning reports, sell it. Don't take chances. If a company you own stock in suddenly changes its CEO, accountant, or auditor, sell. When managers buy their own company stock, buy it too. When they sell too.